afternoon to be with us. I'm sure this is going to be an opportunity for you all to hopefully take a few nuggets away as you are working towards building your portfolio, achieving hopefully your investment objectives. My name is Ali Wadawalji. I'm one of the portfolio managers at ShariaPortfolio, and I will be, inshallah, your presenter for tonight. I happen to be the CEO as well. A lot of you may already have interacted with me, but those of you who are new to ShariaPortfolio or just getting to familiarize yourself with what we do, we are truly grateful for you making it to our session today. And we hope that this will be beneficial for you and your families as well. If you have any friends that are new to us, feel free to let them know that they can join us live on YouTube. I believe we're going to be live streaming there as well if they're not registered. And for those of you that are registered, we welcome you all. Thank you once again for making it today. Naushad Virji, our founder and chairman of the companies that are under the ShariaPortfolio umbrella, he could not make it today, so it'll just be me. So hopefully you guys get to enjoy this seminar, and feel free to ask any questions. We'll try and address them as best as we can, and we will try to make this engaging. I hope the material is something that will cover some of the questions that you guys have had on your minds, and will hopefully give you some perspective on what we have already seen so far and what is our expectation for going forward. So that is what we are intending to cover in today's session. We'll put the PowerPoint up here in a moment so that you guys can see what we have. Fatima, if you can just let me know if the screen sharing has been enabled, and I can go ahead and put the PowerPoint there. And for those of you who are still trickling in, welcome once again. Do feel free to use the chat box, or Q&A box to submit any questions that we can try and address as we go, or at least towards the end, we'll try and attempt to cover those. So we go ahead and try this screen sharing thing once again. All right, and I will attempt to do the slideshow. All right, Fatima, let me know if my screen is on full screen mode. Am I good? Yes, looking good. All right, fabulous. Well, thank you again. I will start right away. There's a lot of slides that I intend to cover, so do follow along. And if you do attend later in the presentation or need a refresher, the recording will be made available to you all. Will be sent out through the email newsletter, and then also will be available on our website and social media channels as well. So thank you. This is a standard disclaimer we put on all of our presentations, so feel free to review that. Of course, this is not investment advice, and for any particular investment for your particular needs, you should consult with an advisor to discuss that so that it is suited to you specifically. I will dive into our growth strategies performance. I am the portfolio manager for our growth model specifically, so I will start by diving into the growth models. Then we will talk a little bit about the market in general. I will then delve a little bit into the value strategies as well as the passive strategies. And then we will talk a little bit about the macro, what we are seeing out there, what is our expectation as well for the remaining parts of the year. And then hopefully I'll try and attempt to cover any questions that may not have addressed during the presentation. So that's the flow for anyone who is kind of following along. So this is how we've done over the last trailing 1 year, means from June 30th, 2024, going back 1 year, we were up 60.5% in the aggressive. The growth was 50%, moderate is 45%. For the first half of 2024, which is basically January till end of June, our aggressive growth strategy, and these are net, by the way, net of fees returns. So we were up 33.5, and this is a composite. So all the portfolios that are following this strategy in aggregate, when we take their net performance, it comes up to 33.5. Growth was 26.96. And the moderate was 24.77. These models are began around January 2021. That was when we began. So there is no longer track record. The value and passive strategies have been around longer. So we'll showcase that in the upcoming slides. But just for perspective, this is how we've done on an annualized basis since inception: 9.2, 7.3, and 10.6 respectively. So for those of you who are following along and who have been in these models, you kind of understand that the growth strategies are generally suitable to those who are comfortable with a little bit more volatility, but are looking for that outsized return potential. In terms of the sector allocations, we generally like to benchmark against the NASDAQ composite for the growth strategies. I've gone ahead and put on this slide how the SPUS sectors are, what the NASDAQ sector allocations are, and what our aggressive growth and moderate portfolios that are within the growth camp look like in relation. So you can see there is some similarities primarily with the growth with the NASDAQ composite, but there are slight differences, and part of that is just due to the fact that we are, as portfolio managers, we have the leeway to determine which sectors we want to overweight or underweight depending on the situation. Some sectors, of course, like utilities or financial services, we're generally not going to have exposure because of halal considerations. But for the most part, we try and at least have a benchmark that we can follow to get us an idea of how we're doing overall. And from a sectoral pie chart angle, you can see the NASDAQ composite is on the left here. And this is showing us, where the bulk of the allocations happen are generally around the technology sector. And we're pretty much similar on the right-hand side. There is, again, some slight differences between the two, but we're using this as a benchmark, so we're not going to steer too far away from this as a way to kind of keep our portfolios more in line with this, as we kind of create the risk and reward and the balance in the portfolio overall. I also want to now kind of talk a little bit about how the different indices performed in the first half of 2024. I've just highlighted a few of them here. Bitcoin clearly has been the leader of the chart. Silver has been quite interesting. We've seen it produce over 20% return in the first half. Gold has also done quite well. The S&P and the NASDAQ, of course, have been doing quite well, last year and so far this year as well. The lagging sectors have been the bonds, and a lot of that we'll tackle into some of the reasoning behind that. But the bond market has been in a bearish kind of flavor, I would call it, for almost 40 plus months now. So there has been weakness in that segment overall, and there is strength in these other categories in the first half of this year. Digital assets, I'll talk about this as a way to portray where is the alpha coming from. So you can see the top three, Bitcoin, Ethereum, and Solana, have been the leaders in the last, pretty much last 11 of the last 14 years. Digital assets have been outperforming. So that is a positive thing for those who are following this space. If you had maintained allocations in Bitcoin, Ethereum, and Solana, I'm not advocating for that, and be mindful that this is just data that I'm sharing. It's not a recommendation, but it's just a way for us to take into consideration what is going on in these categories. And you can see, annualized is 140% in Bitcoin. Solana has been a top performer. And, there are other categories that are also represented. Gold, which a lot of people have been asking about. Historically, if you look at the last 10 to 15 years, average annual return is about 3%. So while it's done well this year, historically, it has underperformed the other categories that are at the top there. So there's something to keep in mind. And we will look at a little bit of a different view on this chart. On this chart, it shows, again, as of June 30th, how each category has performed. So Bitcoin has produced an average annualized return of 147%. Growth holdings, represented by the IWF ticker, has done about 16% per year. The S&P has about 13%. So, when we look at other categories like bonds, which I mentioned has been, the lagging sectors for the last few years, if you look at the BND or even the TLT, not really impressive, considering how other sectors have performed. So something to be mindful of when, allocating your holdings and choosing which segments to be invested in. And emerging markets is another area that has also been lagging for the last few years. And maybe some opportunities could exist in that if you are looking at value, as a value investor looking to hunt for good bargains, there could be some opportunities in that area. But for the most part, with the whole AI narrative and the growth that's happening, a lot of that is represented in the top 3 or 4, line items there. And we're happy to be represented in a lot of those within our growth strategies. And I'll talk a little bit about these specific holdings on some level, and just to give a little bit more color as to how we're able to take advantage of some of these opportunities based on what we are seeing represented here. NVIDIA, of course, I mean, you have heard this since last 2-3 years now. NVIDIA is generally being a name that had come up in the media, and a lot of people were skeptical about the wave that we're seeing with AI. But once the ChatGPT announcement came about and all of the work that OpenAI has been doing and the Microsoft partnerships, we saw that that this is a real theme that's playing in front of our eyes. And if you look at the parabolic move, it's definitely gunning for the most valuable company in the world. It's overtaken Apple, Microsoft a couple of times, but I do feel that NVIDIA could actually take the top spot here in the next few months, considering where the revenues are going and the demand that they're facing. One interesting thing is, over the last 8 years, we've seen 1,000% increase in the compute. So on the right-hand side, it's showing the growth of the compute power over the last few years. And when you have a situation where people might say, look, this is overvalued, but when the revenues are growing at 300% and the earnings are growing by 600%, valuation in reality is more reasonable as to where it's trading right now. I wouldn't say it's cheap, but I wouldn't say it's expensive either, because the revenues are supporting the growth, and that's usually a positive thing. A lot of people have been asking, is this a .com type bubble situation going on, comparing it to Cisco? I really don't think that's the case, because clearly revenues are growing and the demand is through the roof. One of the analysts that I've been following also had a few comments to make about what is going to be the driver for the next leg of the growth. And a lot of that is going to come to that Hopper transition from the Hopper architecture to the whole Blackwell architecture that's about to come. And then there's future developments that they are also going to be releasing. So that's exciting to see, because they're innovating at the same time and not just sitting on their laurels and, kind of milking the current demand wave that they're experiencing, but they're also growing in terms of the innovation side of things. Their data center segment is forecasted to reach 200 billion, by the end of next year. So that's pretty massive just from one category. AMD is obviously right behind them. We've seen other names benefiting, Broadcom and ASML, and there's a whole ecosystem around this whole chips space. But NVIDIA is the clear leader we've seen, and approximately 40 to 50% of their revenue comes from the cloud service providers. And so I think that once we factor in the Blackwell architecture and the fact that they're reducing their overall turnaround time for new products from 2 years to 1 year, tells me that this company is on the ball and they know what they're doing. And we should still see some more exciting stuff happen in this space with NVIDIA at the top of the whole AI food chain. This just literally came out a couple of days ago. I was just looking at this data and I felt it would be worth sharing. The data, the charts just speak for themselves. Semiconductor market size is projected to go from like a 400 or 500 billion to almost $1.2 trillion market in the next 10 years or so. And winner takes most, as you've probably seen in other categories in life, whether it's watches, Rolex is generally seen as the leader. And the same thing happens in investing, right? A lot of times people will often try to diversify too much, but when you have a market leader, they usually will dominate and take most of the share, and that's what we are seeing clearly with the GPU market, the data center, revenues. NVIDIA is showing clearly as being the leader in that space. And in the first half of this year, if we look at this chart here by Bespoke, S&P was up around 15%. If you exclude NVIDIA, the returns are down to low double digits. So clearly, NVIDIA is a big player, and of course, if you take out the Magnificent Seven, the Apples and the Amazons and the Googles and the likes, we're back to like 4% return. So being in the winning assets is very important, we believe, and that's makes the case for some of the active management that we're doing. But of course, NVIDIA has been nothing sort of phenomenal in this ride that we're seeing in the whole AI narrative that has been playing out. I'm going to talk a little bit about some of the other areas. Cybersecurity has been a growing area as well. A lot of that has to do with the fact that there's a lot of malicious attempts, hacking, and so on has been rising across the board. And so there's a forecast of cybersecurity spending to grow 10% year over year to 86 billion this year, driven by the growth in endpoint security. And the leader generally has been CrowdStrike among these other names that are listed here. We do own CrowdStrike in our growth strategies, being up around 51% so far this year. And cybersecurity spending by enterprise is expected to continue to grow because the threats are not going away. And so we do believe that having exposure to this area is quite necessary for the next few years. And a lot of enterprise spending, as I said, is an evidence that this is not going to go away. Even if the economy goes through a rough times, this is not a choice. People need to protect themselves, and cybersecurity spending is an area they're going to focus on to do that. One of the areas I'm sure you guys have heard me talk about before as well is Tesla. So a lot of times the analysts have been focusing just on the car business, and margins are contracting, demand is slowing, and I'm sure you've seen all of these headlines time and again. But I'm highlighting on this chart a couple of things. One is that the Tesla energy storage mega pack business in the Lathrop facility in California that's producing these mega packs, just in the Q2 alone produced 9.4 gigawatt hours of energy storage, which is the highest amount on record, quarterly record at 132% quarter over quarter. Year to date nearly surpasses the whole of last year, as you can see here. So we still have 2 more quarters of data that's going to be updated. And this is what's causing mainstream and Wall Street to finally wake up to the fact that Tesla is not just a car company. Elon Musk has predicted time and again that the energy business is going to be worth much more than the EV business. And so this is evidence that things are moving in the right direction. One thing that's interesting is that is there demand, right? So people might ask, well, okay, there's growth happening, but is there demand for energy? Of course there is demand for energy. Wells Fargo actually released a report recently that said AI power demand is expected to surge 8,000% by the year 2030, from 8 terawatt hours this year to 652 terawatt hours by 2030. So AI training, inference, among other areas are going to be consuming a lot of this power, and Tesla, among other players, are bound to benefit from this, seemingly, endless demand for just the energy. So that's interesting. The other thing I want to showcase on this chart is that there is energy, but there's also robotics. And I'll touch on robotics in the next slide. But you can see that these are multiple S-curves colliding at the same time. I've showed this before. And EVs are obviously growing, but the other areas, such as FSD and robotics and energy are also playing a huge role. And that's where we see a lot of value coming in. According to Elon Musk, this was a recent tweet that was shared. This individual posted that in the year 2034, it just showcasing a future year out there. Tesla is operating close to 100 million robotaxis and over 1 billion Optimus robots, while Tesla is a $24 trillion stock. And Elon Musk responds that this is probably an accurate prediction. So you can just imagine, where this stock is headed should they execute on all of these different initiatives that they're working on. Michael Dell, the CEO and founder of Dell Computers, tried the FSD, and he was amazed and impressed, and he made this comment. So clearly, a lot of those who do own Teslas, you might attest to the same fact that this is pretty much driving on its own for the most part. And this could be very interesting. We're going to be entering the robo-taxi unveiling next month, August 8th. So I'm looking forward to that event and seeing what is it that Tesla has to share. But clearly, once the compensation package was approved and shift to potentially getting the company registered in Texas, among other things, has definitely seen a tidal shift in the whole dynamics with Tesla, and it's been up like 92 or 93% in the last 53 trading days. So it's been a move that it's been sleeping for a while. A lot of people thought Tesla is dead, nothing happening here, but clearly the mainstream media and the analysts are finally waking up to the value that this company has to provide, and is playing a huge role in all of those areas that I just highlighted. So with regards to the robots, which I mentioned, I'll talk about. A lot of people are wondering, how are we going to achieve this thing? It's very simple. If Elon Musk, and I attended this session at a shareholder presentation that they had, I think it was last month, where he said the ratio of humanoid robots to humans will be 2 to 1. Okay, so he believes that for every human out there, there'll be 2 robots per human on Earth. But let's assume there are about 10 billion robots that are built on Earth, and Tesla is able to make 10% of that. So that's about 1 billion robots per year if they can manufacture that. If they do that, and they're making, let's say, 100 million units per year, they make 1 billion over 10 years, and they make maybe 100 million per year, and they sell for 20,000. Cost of production is 10,000. Right there, they're making 1 trillion in profit per year just on the robots. So you can just imagine where this company is headed if that is the kind of revenues they're going to be generating. And that's just the robots, which I think is the biggest opportunity. Of course, according to this pie chart, you can see the robotics makes up the biggest pie of where the revenue is going to come from. So that's what this 24 trillion does. And if it does cross the 30 trillion mark, which Elon Musk has stated is very much possible, it's going to be difficult, but feasible, very possible to do. That could take the stock north of $8,000, and we're trading today at 250 or 260, somewhere in that ballpark. Next phase that I'm going to talk about is Bitcoin, and again, I'm going to try and cover as much ground as I can. So if I sound like I'm trying to move quickly, it's because there's a lot of exciting information I want to share here today. But hopefully you guys are keeping along with me here. If you need your chai, please grab it. I'm going to hydrate a little bit here for a moment. So Bitcoin adoption, where is Bitcoin going? If you look at the chart on the left, and I've shared that, Metcalfe's law is very interesting in the sense that, the more users are on a network, the more the activity takes place, the more the value. So this is why it's important to look at the adoption, because you could have the most amazing technology out there, but if nobody is using it, then it's worthless pretty much. So you need to see adoption. And so far what we are seeing is the Bitcoin adoption is accelerating faster than the internet adoption. And we're pretty much at the level that we were in 1999 in terms of the users. So just imagine if you are just entering this space and learning about Bitcoin and where the adoption is going. Clearly we know today there is the number of users is much in the billions, and we're not there yet with Bitcoin. So just imagine once the world starts caring and adopting this thing as is projected here, we could see some very interesting numbers going forward. A lot of people also, we've talked about the cycles. Bitcoin goes through the halving cycle every 4 years. Clearly in 2016 was when the chart ripped. After that, it took some time after the halving. Generally things take off. 2024, we're kind of at that level where it's a bull market. Clearly we've seen the first half, Bitcoin was up over 40%, but it's kind of in this consolidation mode, and a lot of people questioning, is 60,000 it? Are we not going to see anything more come out of Bitcoin? I believe that based on history, there's a lot more that we could see ahead, and I do believe that 100,000 is very much possible before end of this year. So we'll see what happens. Here's another visual for those who want to see it from a different perspective. Again, every 4 years there is this halving cycle. We're kind of in this consolidation phase. After the 90 days from the first halving generally can be a little bit weak, but generally most of the returns tend to happen in the 12 to 18 months after the halving. So based on the previous cycles, you can clearly see that, in the first cycle, of course, that was massive, right? Where we saw an 87x return. We may not see something as huge as that, but from what we've seen, generally the first 3 months after the halving, which we're pretty much coming to the end of that 3-month year, are not that huge. But in the 6, 9, 12 month, as time goes by, the returns tend to be very strong. And so, patience is required for disruption and assets like Bitcoin. And keep in mind, talking about Bitcoin and crypto are not synonymous. Crypto, if anyone has been invested in that space or is familiar with it, has a lot of craziness. So I'm not advocating for anyone to just go out there and buy that next top big thing out there. There's tons of tokens coming out every day. But Bitcoin is special on its own, and I generally like to focus on the where the safety has to come first. We don't want to talk about assets that could go 1,000%, but then have the characteristics of memes and other craziness. So that's not what I'm here to express, but I do believe Bitcoin has its own characteristic that make it appealing. If you missed the Bitcoin webinar, by the way, which we did in April, just before the halving, we had done a Bitcoin webinar. That is available. You can view on our website or on the YouTube channel. Is available there. So I'm not going to focus too much on that, but I'm just talking about where the future might be going based on the historical data that we've seen post-halving. I'm going to dive now into the passive strategies. So in here, we're showcasing the returns in terms of year-to-date, trailing 5-year, trailing 1 year, trailing 5-year, trailing 10-year. Wherever we do have that information, we are showcasing that. So aggressive has definitely been doing quite well year to date. It's up 18%. Trailing 1 year is 24%. On the other hand, Sukuk has been, generally the area where people come to for that stability, safety element. Year to date, it's up 4%, which is pretty good for a category that is meant for stability and capital preservation. And an 8% trailing 1 year, I think, is pretty good for Sukuk. So just to give you perspective, right? The higher the risk curve, the higher the expected return. And that's what we've been able to achieve with our fund strategies. For those who want an idea of what our fund strategies look like, this is the breakdown here. Of course, Noshad has talked about this previously, so I'm just showcasing, kind of give you perspective on the allocation that we have. And this is tweaked periodically depending on what we see as the best, way to allocate. But this is kind of what comprises some of our values, our passive strategy. In terms of our value strategies, we have definitely seen also a trend similar in the sense that aggressive has done well, while the passive while the conservative strategies have also done well in relation to what they're expected. So if you're in a conservative strategy, 3 to 4 or 3 to 5% is realistic. That's what you're aiming for. If you're looking for alpha, generally I would say 8 to 10% is what the aggressive strategy in the value or even the passive camp is looking to achieve for you. Keep in mind the conservative, I put an asterisk there, the inception return was June 2020, so there is no 10-year or 5-year for that one. The rest of them that do have the 5 and 10-year, they have been represented here. And so far, this is kind of the representation of how the value strategies have done. If you want a little bit of a deeper insight as to what the allocations look like, the value strategies have the following in terms of the asset allocation and the sector allocations. So we're generally looking at the S&P 500 as our benchmark for the value. And if you remember earlier, we mentioned the growth, for the growth strategies, the NASDAQ is what we're using as the benchmark. And that's where the differences lie in the allocations and the holdings as well. But just for perspective, I wanted to share this so that you guys have a little bit of a better understanding of as to how we're allocating in this, in terms of our assets that are in following those strategies. So you can see technology generally has been making up the bulk of it, and that's primarily because technology weighting is much higher on the S&P, it's about 34%, and even the SPUS, which is the S&P 500 industry exclusion, ETF that excludes the non-halal holdings. If you have that fund in your portfolio, I'm sure a lot of you already do, that generally has 48%. So almost half is in technology, so which makes sense. Technology will make a bigger share, but there's more representation of the other sectors here, which is a little bit of a different look as compared to the growth strategies. So I'll show the growth a little bit again here. You can see the allocation is 62% in the NASDAQ. So of course, technology makes up a lion's share. So they're not apples to apples comparison, but for those who are looking for the flavor with disruption and higher risk, high reward, the growth portfolios may be an area to consider. But for those who are looking for more steady returns, mirroring mostly the S&P 500, the value or even the passive strategies might be worth considering for you. So I'm going to dive a little bit into the next section, which is talking about the macro. Like, what is it that we are seeing in the current environment, and what is our expectation going forward? So far, Bank of America research has shown that when you're in an environment where GDP is slowing down and earnings per share is accelerating, that typically makes up the best environment for growing, for growth in equities. So we are definitely in that, GDP has been declining. At the same time, based on the companies that have been reporting, earnings have been, over 80% of companies that have reported on the S&P 500 have beaten the estimates, and generally, in many cases, raising those estimates as well going forward with their guidance. So that tells us that we're seeing strong earnings, and even if GDP is contracting or slowing down, I should say, we are poised to do well. And so a lot of people concerned that should we be concerned if growth is slowing down in the economy? As long as earnings are growing, I think that should be a positive backdrop for equities. Debt and liquidity is another area we need to watch. I laugh about this, but it's not a laughing matter. A U.S. debt currently standing at 34.6 or 34.7 trillion is projected to surpass 50 trillion by the year 2034. I mean, it's mind-blowing the amount of debt that the U.S. is carrying. The interest on the debt alone is now above the spending that is, for Medicare and defense and other categories. So you can imagine how much is being spent just on interest on this debt. And that shows the fiscal irresponsibility, not just of the US, but this is a problem in a lot of other countries as well. And as the deficit grows, it's going to affect, what is it that, is going to, the value of different things out there. So, you want to definitely be mindful of that. In terms of liquidity, I think that liquidity is expected to perk up. We're already seeing an uptick, and similarly, the M2 money supply is also, if you see the circle there, it's usually a sign of what is yet to come. So when the money supply goes up, it's an indication that more money is circulating in the economy. Increased liquidity can lead to more funds flowing into various assets, including risk assets like Bitcoin and others. And so that can be a positive backdrop for what we can expect to see in terms of future performance, especially as liquidity rises. And that's something that we're definitely watching out for as we go forward. We do think that election years can play a role as well in the liquidity cycle. Regardless of who wins in November, I think that liquidity is expected to go up, and that should be positive backdrop for equities. One thing that I think is also concerning here is that during the 2008 global financial crisis, there was 6 billion in unrealized losses on securities. Currently, that's standing at 650 billion, so or 675 billion there. So banks have almost 10 times the exposure pretty much as to what was happening in the previous crisis. I think there's whoever's looking at this can take away that there's a lot of pain and suffering that is happening on these bank side. And I think that a lot of these treasuries which they are holding underwater are going to affect them. And so I think the Fed, looking at this kind of information, has to soften the blow on them, and that's why one of the reasons I believe that interest rates are going to have to come down. And at the same time, we're seeing a rise in credit card and auto loan delinquencies. So when you see data like that, it shows that the middle and low income families are definitely hurting. And if consumers are not going to start spending, well, guess what? GDP, 70% of that is comprised of consumer spending. So if the Fed does not want to grind the economy to a halt and completely slow down everything, they're going to have to make something change, right? And so I think that these interest rates coming down with increase of liquidities is going to be hopefully a positive thing to see going forward. And we're starting to see some positive comments on that front with the Fed talking about rate cuts. We saw jobs data showing growth slowing down. And we're already seeing there's over a 72% probability as of now that we're going to see a rate cut in September. Tomorrow, CPI data will be something we are going to be watching carefully. I do think that inflation in general, as you can see, has been kind of slowly coming down. From the peak of June 2022, inflation is coming down, and if inflation is coming down, and labor is soft, and we're seeing slowness, and area where there was a lot of strength previously has definitely kind of slowed down. That could be a reason for the Fed to cut, in addition to the unrealized losses we mentioned and the banks hurting. One or two banks falling under, like Silicon Valley Bank and others that you heard about earlier in the year. If anything like that were to happen again, I think that will accelerate the possibility of these rate cuts. Sorry. So with the labor, we're seeing continuous jobless claims hitting a highest level in over 2 years. So it's not all dandy and rosy out there. I know a lot of people, families that I've talked to are struggling. During COVID, we also saw a surge in software development jobs, but clearly that has fallen back to pre-pandemic levels. Even an area that is technical, like software development, is seeing, the demand slowing down. And I can hint, maybe AI has something to do with some of the, decline in this segments. But also Bloomberg had come out with an estimate for the job report, stating that there was, payroll prints, non-farm payroll prints had been overestimated or overstated by 730,000 last year. So clearly, there's usually a revision of some of this data as we go forward. And I do think that, unemployment or the labor market is not as strong as was assumed to be. And that is another area that could force the hand of the Fed in terms of, bringing easing of the financial conditions. Let's talk about, where does the future go? Where do we see the rest of the year? Again, we're not fortune tellers, but historically, June, July, and August are the best 3 months of an election year. So far, today, S&P crossed 5,600 for the first time. At the beginning of the year, all the analysts that were surveyed on Wall Street, nobody had a target as high as even 5,200 for the end of the year. And we're just at the middle of the year, and we've crossed 5,600. So that tells you a little bit about how good some of these analysts are with their forecasts. I do think that so far, the seasonality is playing out as we had expected and what the history has shown us. There might be some volatility in end of Q3 here and part of Q4, but generally speaking, second half after a strong first half generally is the case that we've seen. So according to Bank of America Global Research here, we could possibly see a rally in the 88% of the time in the second half, and that could be take us to 59.25 with an average annual rate of return of 8.5%. Or if we see a 10% return, that could take us to 6,000. And so a lot of people, again, who are skeptical that this market was, initially we were hearing a lot about this is just a bear market rally, or how can the market go up in the face of rate hikes? That was the story last year. But as we've mentioned time and again, the market is a forward-looking machine, right? Think of it as, what is the future expectation? If economic conditions are expected to ease, and think about it, once the rate cuts come in, which there's a high probability of us seeing that in September, guess what happens to technology and other risk assets? They tend to rally even harder. And already technology is such a huge weighting in the indices that if this rate cuts do happen and lifts up the technology and other risk elements, we could see some really spectacular numbers even in the second half, despite the double-digit returns that we've already seen in the first half. So, I'm kind of optimistic. So in general, I'll say that, look, the US dollar has generally been strong. I wouldn't say it's been weakening, but I think that is the expectation in the short to medium term. So if the US dollar does weaken, the peak was around October 2022 at around 114 or 113 on the dollar index, DXY, if you're monitoring that. Right now we're around 105. So if we see more, softening or weakness in the dollar, that should be positive for equities. The volatility index, commonly referred to as the VIX, has also been declining, and that's usually a positive catalyst and environment for equities. Oil prices have been a little bit here and there, but with inflation falling, we do, there has been geopolitical concerns which can definitely sway the price of oil in the short term, but the trend by the EIA and other industry data that we're seeing is pointing to the fact that oil prices are going to be in a decline for the next few years. And summer driving season, if once that winds down, that's usually where a lot of oil is used. Maybe that could be another reason to see things kind of cooling off in the oil. So far there are 2 rate cuts expected in 2024. And Jerome Powell earlier this month has noted that we've been making progress on inflation. So as I pointed out in the previous chart, there's an expectation that we see the first one happening in September, which would be very good for risk assets. There's also almost $6 trillion still. I know I've mentioned this $6 trillion previously as well. So a lot of people, they're going to have a moment of reckoning at the end of the year. They'll be looking and saying, okay, although as Muslims, we don't generally have money market, but those who have been hiding in money market, earning their 4 or 5% yield, will look back and say, well, S&P was up 20% last year. This year, first half, 15%. Let's say it gains another at least 5% more. We could be up at least 20% this year. And so some of those people who are sitting on cash or cash equivalents in money market, they'll be questioning, why are they doing that? And I do think some of that will trickle back into the markets. Possibly some of that bond allocations, which, as I mentioned, has not been doing as well. Some people may shift the bond allocations also back into equities, which could also be fuel for the rally as we go forward. And as I mentioned, improving liquidity, more QE, more money printing, uptick in the M2 money supply was one of the reasons for the pivot as well. So I think that these are the different reasons that could take us longer. Of course, there are risks like geopolitical concerns, or if earnings slows down, unexpectedly going forward, or if inflation shows an uptick, which I don't think is the case. Everything is pointing to the fact that the things that were contributing to the tightening are now, we're now seeing a reverse of that with the data that we've been seeing, and so that could be very positive for the environment going forward. One thing with technology is, even if we're in a tightening environment, the reason NVIDIA and other stocks have done really well is that, this is enabling bringing of costs down. Deflation enabling means how can we bring the cost down? So when you have efficiency in training these language models, or in real world AI like robotics, we can have a world where abundance can lead to everyone having a better quality of life, the cost of goods and services coming down so that it is less that we have to spend on these things. And that's exciting, I think, on many levels. And a lot of these different technologies that are playing out in front of our eyes will be very positive for the world as we go forward. So with that, I want to thank you for listening to what I had to say. I know I've been talking for quite a bit of time here, and maybe take a look and see if there is any questions that I can try and address. So question about considering holding Bitcoin or Ethereum. Well, the way we're getting exposure, to be honest, in this, and I'll go to this, we are holding Bitcoin proxies, not necessarily buying the ETFs, because one way to invest in Bitcoin is you can buy Bitcoin yourself. And we covered that in the earlier webinar in April on just the topic of Bitcoin. You can buy the Bitcoin and put it in cold storage if you're comfortable with doing that. However, if you are looking to invest it through your brokerage account, you can buy it through the ETFs, like the ones that Fidelity or BlackRock have and others. Or you could buy proxies like MicroStrategy, which is in our portfolios, or CleanSpark, which is a mining stock. So this is another way to gain exposure to this space. So this is something to keep in mind. And so, yeah, hopefully that addresses that question. We're not owning Ethereum. Personally, I'm not as giving you my 2 cents. I'm not an expert, but I think that Ethereum's growth and the technology is not as superior as the newer technologies we're seeing. For any technology to succeed, you need adoption, as this chart here shows with Bitcoin, but this can apply to any other technology out there. So you need more users. You need the cost to be very low, and the cost to transact on the Ethereum network is very prohibitive. So that's why other technologies are taking share from Ethereum, Solana being one of them. And it has to have, so there has to, just think of it like a shopping mall, right? If you want to go into a mall and nobody's shopping there, it could be the most fanciest of malls, but it needs to be buzzing. There needs to be a lot of activity, a lot of people, footwork, and that's what you need to see as characteristics. So you have to have security, you have to have growth in terms of the dApps that are being built, in terms of the users, and you have to have the cost being down. So if you can hit this, there's a lot of use cases out there, and I think that there's definitely some exciting. You're probably seeing ARK Invest, VanEck, among others, filing for the Ethereum and even the Solana ETFs, which are very exciting for the whole digital asset space. And so I'm kind of excited about what the future has to bring for us. Let's look and see what else I can. Yeah, so the S&P 500, as I showed in this, so someone was asking how the funds have performed. This chart shows how they've performed, with regards to the S&P here. SPY is the S&P 500 is about 13.5% per year. For first half of the year, it was up 15%. So if you're looking at any of the strategies that I was covering, in terms of performance, you can always compare that here and against, the indices as well. So hopefully that addresses that question. Let me go back to the question and answer. A few more. Can I invest your fund through my Roth IRA? Absolutely. If you want to invest in any of these passive funds that I've highlighted on this chart, you're welcome to own this directly in any brokerage account, as well as IRA account that you wish to have. And if you want, again, to discuss with one of our advisors and have your what do you call it, consultation with one of our team members, we are more than happy to coordinate that. You're welcome to reach out to the info@ShariaPortfolio.com or give us a call, and one of our advisors will be happy to speak with you. And for those who need to know what our number is, you can always look at the thank you slide at the end. Sorry, I went too fast there. So yeah, our slide, you can always, I always joke about our number, 888 halal stock. is the easiest way to remember our numbers. So if you ever forget, But what individual stocks do you think have a good potential for growth in the next 5 years? Well, I cannot offer advice on individual stocks. I can only comment on whatever we're investing in. And I do think that some of these that we have been investing in, active portfolios means we're going to pivot at some point. We'll adjust allocations. We'll adjust when to buy, when to sell those. That's where our portfolio management team comes into play. But of course, happy to have a one-on-one with you to kind of understand your goals, because what works for you may not work for someone else, or the volatility and other considerations have to be looked at. But if you're closer to retirement versus if you're young, that could affect how we answer that question. So hopefully that explains. But I do think that some of the sectors and themes that I've talked about, I do think they show a lot of promise going forward as well for the next few years. So someone has a question on whether we can manage portfolios through a different brokerage platform like Fidelity without moving their assets over to Schwab. Good question. Schwab, by the way, is the brokerage custodian that we clear with. The challenge with Fidelity has been that they have requested, or their requirements have been that if we wish to clear through them, that we need to have a large, substantial AUM, assets under management, on their platform. And making that kind of commitment is not something that we were able to or ready to commit to at the time. We are going to keep engaging with Fidelity, because I do believe that we want to be able to serve our clients as best as possible if we can. But for now, I do believe Schwab is very reputable. We are currently managing from all the companies that ShariaPortfolio represents just close to 1.1 billion as of right now. So I think there's safety. A lot of these portfolios are all given the same insurance protections with the FDIC and the SIPC insurance. So if anyone is considering making that transition, our client service team will make it a very seamless transition for anyone looking to transition from any other brokerage platform over to Schwab. And our team here is here to serve you as best as we can. So hopefully that helps. Easiest way to buy Bitcoin. Again, this is not something I want to address necessarily in terms of how to go about this. I would recommend check out the Bitcoin webinar. It does delve into this a little bit more. You can buy through the decentralized exchanges like Coinbase, among others, but there's, you have to be mindful of the risks of investing or buying things through those platforms, because I would say trading is not the same as holding and custodying. But a lot of people, if you remember FTX and other things, so that's the reason these ETFs have ushered in a new movement of investors coming in, those who are concerned about safety, stability, security. You can get that on the Schwab and Fidelity and other platforms that you would not traditionally have been able to do so if you're considering assets like Bitcoin. So hopefully that helps. If someone has an IRA with Schwab, is it possible to be managed by ShariaPortfolio? Absolutely. Feel free to send us the details and discuss with your advisor, and we are more than happy to coordinate the transition for you and assist with managing that on your behalf based on your age, your risk profile, and your investment objectives. So hopefully that addresses that question. Where are SPUS and SPTE approved thus far? Pretty much any platform. These are publicly listed on the New York Stock Exchange. So if you want to buy any of those ETFs that I mentioned in our presentation, and if anyone wants to get a little bit more information about the ETFs and the funds, feel free to visit sp-funds.com. It has the prospectus and all other information that you might find helpful. But these are publicly listed, so you should be able to buy them pretty much anywhere that they're approved. Sometimes 401ks, 403bs might have certain restrictions, so just as an FYI. But if you have a brokerage account anywhere, pretty much you should be able to buy them there. What other new ETFs can we invest in other than this? Well, we have SPUS, SPTE, SPWO, and we also have SPRE and SPSK. I've already showcased those in the slide. The website has more info. We launched some target date funds at the earlier part of this year, and these are available as well in terms of the menu that investors have to consider. So feel free to visit sp-funds.com for more information on the target date funds that just literally launched earlier this month, just a few days ago. These are available to investors who want, especially in their 401ks, who may not want to tinker around with the allocations and all that. It's more of a way to passively invest and have the allocations adjust automatically based on when you are expected to retire. So check those out if you get a chance. Regarding dividend purifications, you can look at that on the SP Funds website. There is information on that there. In terms of which shells are you guys on? I would like to better understand the ownership structure. Do you guys disclose that at all? I'm not sure exactly how to address that question, but we can always get back to you. Now, Shad, usually it would be the person to address some of those questions. So since he was not able to make it today, I'm attempting to answer some of these questions rapid fire as best as I can. I know we're almost at the top of the hour, so if anyone has any other question, feel free to throw them my way. I'm happy to address for the next couple more minutes. And again, as a reminder to anyone who did not attend the presentation early on, we will have the slides, or the recording, I should say, available on YouTube, and we will send the recording as well through the newsletter once it is available. So we do definitely recommend checking that out. If you are looking to get an understanding of ownership structure, yes, please do check the ADV filings. They do cover that as well. Hopefully that addresses your question. I see something on that. And our ADV filings are publicly, if you go to the website, you should be able to access it there. And it's all available out there as well. For those who want real estate information on we have a private real estate fund that is available through SP Funds. If you're looking for more information, you're welcome to send us an inquiry, and we can have someone on that address that with you to discuss the opportunity, because that is not something that is available to all investors and accredited only. But definitely for those who are interested in the real estate opportunity in the private real estate fund, there is some information that we can share and discuss with you separately. Absolutely. I will be happy to share that with you for the person asking about the Bitcoin webinar. All right. Anything else that you guys have? And feel free to share feedback in terms of any other future content that you guys want to see with us address. We're happy to go over that with you and prepare a seminar down the line on a specific topic. I know a lot of people generally have had this in the markets. I'll just leave this thing, where people say sell in May and go away. Well, so far this year, if you followed that slogan or advice, you would have missed out on some of the most biggest gains that we're starting to see in June and July so far. I know April was a little bit of a weak month, but we're seeing strength come back in the equities once again. And so, you don't want to sleep on this market, especially given the strength that we're seeing so far. So I just wanted to mention that. For anyone who wants to access the Bitcoin webinar, that has been shared here, the YouTube link. Thank you, Fatima. So you can feel free to view that there. Thank you so much for those who are sending in the comments about our presentation. We really appreciate the feedback. I'm reading some of the comments here. I'm honored and happy that it's helping you and benefiting you guys in your investment journey. Our job is to be able to help you, make sense of what's going on out there and to find ways that you can position yourselves in the most fantastic ways possible, depending on what strategy works best for you. All right, so I'm going to wrap it up there. I see we've tried to address hopefully every single question here. Regarding balancing between long-term stocks or real estate, I don't think one or the other needs to be the winner and the only category one considers. I think that everything works in a cycle, just like, there is a space for stocks, there's a space in one's net worth and portfolio for real estate, there's a space in one's net worth for other alternatives as well. It just depends on what your flavor is, what your preference is, and we can guide you in terms of how to best allocate and best position yourself depending on your particular goals and needs. So that's where our team would be happy to discuss with you. So thank you so much once again. I hope you guys enjoy the rest of your summer. We look forward to serving you and meeting you in future webinars. And if anyone did not get a chance to attend this, feel free to share this with a friend or colleague. And inshallah, look forward to serving you as a client if you are already one. And if not, our doors are open. Happy to speak with any of you. Thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.